Allison, we're going to do two things in the period of time we have. Talk about how Allison, as an institutional investor, has gone about, she's retired from Rice, but has gone about investing in the private markets, and then advice and what she would do if she were in your seat. So let's jump in there and start with why bother? Right? Public markets have been great for a long time. Until recently, bonds have been great. Everyone's met their spending needs. So why bother with all the alternatives in the first place?
So it's a great question. And honestly, as I go around and talk to individual investors, I think in smaller institutions, it is the #1 question I get is, why do you bother with this? And not only do university endowments bother with this, it's an increasing share of their portfolio. It was almost 40% of the allocation of the top endowments is to private equity and venture capital as of last year. And it was more on the order of 20 to 25% 10 years ago, and probably 5% 10, 15 years before that. And so what do they see that they like? It is that private equity and venture have offered us somewhere on the order of 300 to 700 basis points of outperformance over those periods. And we are heavily, all of us, heavily dependent and incentivized to outperform and to push these portfolios as hard as we can. Because for Rice, for example, the distribution off the endowment covers 40% of the budget for the university. And so what we see when we look at the data is just a very, very compelling outperformance on the order of last decade's 17% versus stocks, we earned about 11%.
So once you decide to do it, you mentioned 40% of a lot of endowment totals. What did your portfolio composition look like at Rice?
So you can think of us as having about 30% in private equity and venture capital, on the order of 20% in hedge funds. And then the remainder is split among stocks, bonds, and real assets. Given our location in Houston and the history of the university, we actually have a very large allocation to real assets. It's one of our areas of competitive advantage. I mean, you and I have talked about this before. We played to our strengths. I think our asset allocation is a little different from many institutions.
So to deploy that much in this space, what does your team look like?
So the team, I think that the introduction was very right. Effectively, the team could be whatever size that I could convince the board that it needed to be. So we spent, on average, about $15 million on our investment team overhead at the university, inclusive of technology costs and kind of custodial costs, et cetera. But that looked like about 30 people, half of them back office, half of them on the research side. In private equity and venture capital alone, 10 years ago we had 1 person, and today we have 4. 1 senior person, 2 kind of mid-career experienced people, and an analyst.
So if you had 4 on the investment side, what type of operational support do you need just in the private markets to support those 4 people in the processing of all the documentation paperwork?
Oh, wow. And it is the heaviest operationally intensive part of our portfolio as well. The LPAs are complicated. The reporting is complicated. Every single report looks different, which is not helpful, and I've seen no movement on that front. And so I would say possibly half of our back office was focused on the reporting aspect around that. And so if we had 4 people on the investment team, we probably had 3 people who had a pretty heavy component of their day-to-day oversight on the operations side related to private assets.
So what do these 3 or 4 investment people do in their day-to-day to find the best investments you can in private markets?
So sourcing and finding those managers is probably 75% of the job, and 25% of the job success factors is making sure you keep up with those managers. That's not how the time gets split up necessarily, but that's probably what's important. So I wanted to hire people who had experience in selecting private investment funds. So you're looking for somebody who has a research background, potentially at the senior level has actually picked funds before. We utilize several independent data sources to look at funds and review them. Each of us has an extensive network in private allocators to capital, right? And so a lot of your best recommendations come from talking to other people, going to events, and understanding what you as the client need. So what are you looking for? And then just pulling on threads.
What goes into the due diligence, the homework, to get from you've heard this might be a good fund to it's a fund that you want to recommend to add to your portfolio?
So to some extent, it's time. One of the things that we notice about private investments is everyone tells you it's a 5 to 7 year fund, and then it's really a 10 to 15 year fund. And so we spend a lot of time getting to know the managers up front. And if you don't have that time, I think you need to default towards brands and bigger, longer track record firms. But that's not where you get the best performance. And so you're stuck in a really difficult conundrum there, which is that the big funds have great research, lots of references that you can call and speak to, but they don't necessarily have the best performance, is the reality of it.
So you're also not the only institution with a research team. In fact, at whatever it is, high single-digit billions, you could say mid-sized compared to a lot of your peers. How do you go about competing for allocations to what might be, say, if it's not the biggest funds that have capacity constraints, when there are other people just like you trying to get into the same pools?
So at the big funds, it's never a problem, at least for us, right? At $8 billion, our average commitment size was $35 million to a fund, and we'd probably do up to $70 million in a fund, which a big fund is a very moderately sized check. But our best performing funds at Rice over the last 20 years are ones where they, in general, have kept their fund sizes small. And so you do have to compete with your brand, your mission. You have to represent your money and say, here's why you want to take money from Rice University. Here's what we do with that. Here are the scholarship recipients. Here's the things that we do with your money. And for those best firms, they are looking for that relationship. So that's really complicated. I don't know how you thread that needle when you're an individual or representing a kind of more dispersed group of clients. I do think you still try to tell that story, try to build a relationship. We tend to say to people back to that, the average fund is closer to 15 years than to 5. We try to say we're going to be here for the next 3 funds. And so you spend a lot of time in due diligence. It's multiple visits to their headquarters, them coming to visit your headquarters, phone calls. It's taking the track record apart and comparing the numbers. It's making sure that you actually believe your client, in this case Rice, was going to be better off than in a liquid alternative.
So in the institutional market, in the last couple of years, there's a lot of noise about there being too much of an allocation to private markets. A lot of money raised going into 2021. How is that playing out among you and your peers?
I think it's mostly an endowment-specific problem, maybe an endowment and pension problem, but I remember sitting at a conference a year ago talking to a group of endowments, and they said, wow, if distributions don't get better within the next year, we're going to be cutting into muscle in 2025. So I'm guessing that they're cutting into muscle because distributions aren't any better. I thought your statistic about the dollars that have gone into privates versus the dollars that are coming out are probably worth mentioning. And so most of us in the endowment, foundation, and pension space are fully allocated or over-allocated to privates right now, and it can happen in a snap. I sit on one investment committee for a large multi-billion-dollar endowment, and their target was to get to 30% allocation to privates. They're currently at 52%. And this is because the calling of capital was significantly faster than they had modeled. And so the board has decided to pare back or reduce down our future commitments to current vintages to try to bring that asset allocation back in line. But for an institution that wasn't as long dated as this one is, it would be a real problem.
What are some of the challenges, this being one of them, when you're constructing a portfolio of private managers in sizing and timing and all these things that clearly, if you think you're going to be at 30% and you end up at 52, that's not a good thing?
Well, you do use, forecasts based on past predictions are never a good forecaster of future returns, right? So I think you model out what you believe the fund is likely to do. And I mean, rule of thumb is that they're going to call down most of the capital over 3 years. Maybe it's 3 to 5, and occasionally it's 18 months. And that's what happened in 2020 and 2021. So you model it as, you know, they take it over 3 years, and then that you get it back starting in about year 5 through year 12. And I think that that has served private investors pretty well over time, running those models, but it has completely stopped working over the last 3 to 4 years with the capital markets, IPOs being slow, M&A activity being slow, and the capital calls that were just like a tidal wave in 2020.
So what do you think happens over the next couple of years with the institutional allocations to private markets?
I think we have to be, for the E&F world, endowment and foundation world, at a steady state. I mean, a 40% allocation to private equity and venture capital feels okay, but full from my standpoint, given the distribution needs of the portfolio. So I really think that the managers are going to be looking to you all for growth. This is where there are assets that aren't in private asset classes right now. And so I expect you'll see more and more calls and solicitations from the asset managers over the next 5 years because you are their growth path.
So let's turn to our audience and the wealth advisors. The institutional world, 40% privates. I think on average on the wealth channel, it's somewhere between 2 and high single digits. Mm-hmm. What do you need to think about as you're starting to build a program? As just what are your opportunities to participate in the private markets today that would make sense to you if you, as you did, left your seat? If all of a sudden you're managing money for a bunch of families, how would you go about that?
So I've talked to a few people, even just this morning, as well as people in Houston over the last few months. And I think a lot of people say, why bother with privates? We are achieving our goals using public markets, and we have perfect liquidity, so why bother? I'd give you 2 answers. One is, if you're standing still, you're getting left behind. And I cannot imagine that any of you in this channel don't need to have an emerging opinion about private asset classes. And certainly your clients are going to expect it over the next 5 years. You're going to need to be able to talk about it, the pros and the cons. Even if you don't do it, I think you need to have an opinion about it. The second thing is that we've all been able to achieve great results in our 401ks over the last 10 years because the equity markets have been fantastic, particularly in the US. That does not happen every decade. The decade of the 2000s, when I was working at a mutual fund, I think the only way my 401k grew was via my contributions into it. And so you can go through a period when returns are much more difficult to achieve, and private asset classes, whether it's private credit, private real estate, or private equity and venture capital, do offer potentially another return stream that might not be fully correlated with public asset classes. And so I think it's a very intriguing thing to add to a portfolio. I would absolutely add it to sophisticated investment portfolios because I do believe that if you look at the history of the asset class, you can probably get 200 to 400 basis points going forward outperformance. Maybe it'll be better and maybe not, but it offers you a differentiated return stream, and it offers you the potential to outperform equities or outperform the corollary credits. So I think it's worth doing it. The question is what? And I think what I would say, and what I have been saying to investment committees that I sit on, is that I am very biased right now towards larger shops that have been in the business and have the ability to provide or find creative liquidity solutions if the asset allocation models are wrong or the models are wrong. And so I probably would start to get to know this asset class and do a lot of research on it at this time, but I also would probably start with places where there's a material business being built.
So if you take that a step down, you said earlier that the big funds don't have the best performance. So it's hard to go to your clients and say, we're going to get you into this stuff, and it'll be just fine, but not good. Not that that's exactly the pitch. You have different options. You have the big funds, you have fund of funds, there's secondaries, there are the platforms like an ICAP and a CASE. How would you think about how you would want to deploy capital for a group of families?
I do think secondary funds can offer you an interesting alternative there. One, if you think about it, the E&F world and the pension world's a little over-allocated to privates at this time, so maybe they're going to be interesting secondary offerings right now. And when the markets are locked up in IPO and M&A land, you may actually have an advantage if you had fresh capital to invest in secondary funds. And part of what that is you are buying into an existing stake from someone else. So let's say Rice University, or that endowment I was talking about that has 54%, let's say they wanted to take it to 45% allocation to private assets. The only way they could do it is a sale to a secondary fund of their pieces of their existing portfolio. And I do see a lot of activity in that area. On the performance point, the number one rule is always do no harm and don't lose money. I think one of the things that boutique asset managers can offer you is excellent performance, but they can also offer you occasionally really bad performance. And so one of the things that the large firms do, and I think it's a very sound strategy, is they offer you second quartile performance or median performance, but without a lot of the risks of a disastrous outcome. And I think when you're getting started, and even when an institution is getting started in privates, that's often where you want to go.
No one here is going to have a $15 million budget to spend on research and operations for their own investing. What's the minimum that you think you would need to deploy to be able to make good decisions, unless you just want to default to, we're just going to invest in one of the mega funds?
So when you say deploy, you mean the minimum you want to deploy from an
now, how much
team?
Money, how many people do you need, to go about this in a thoughtful way?
I mean, at a minimum, you need 1.5 people, I would say.
Where do you find the half?
A senior and a junior person. Where do you find that? I do not know where the half. The half is probably the analyst that can do a little bit of whatever you need whenever you need it, and only half of them is actually doing privates because the other half is doing whatever else you need. You've got to love the haves, right? But you probably need people.
Nots, you know.
Ted's like, come on, what is a half? But it's a real investment. And I think depending on what city you're in, there may or may not be private investment expertise. And depending on what you can find, there may not be excellent private expertise. One of the things that surprised me, and you know, we've talked about this a little bit, is just how little sources of research are out there to be procured for this investor channel. And I think that that's something that probably needs to come around for you all to have more than 3% or some de minimis amount of your portfolio invested in private asset classes.
When you started to see some people, different wealth channels, I know you're on a couple of foundation boards, start to deploy in the space, what are some of the worst practices you've come across?
So one of my favorite things to do is to sit on investment committees for nonprofits, and I sit on several investment committees where they have on the order of 80 million, 150 million, and we'll have an investment committee, and it's very interesting. Basically, these small endowments are at the place where Rice University was in 1990. They kind of have one person running the portfolio, and then you have a board of well-meaning experts who come in and vote on whether they should do the thing that the investment advisor recommends. And honestly, it feels very poorly researched right now. So one of the committees has a $150 million endowment. We're advised, I'm allowed to say it, right?
Yeah, go for it.
By a Greystone advisor.
Anyone from Greystone here? You might want to put earmuffs on right now.
Well, I mean, actually, I'm really irritated. I'm super irritated because purportedly it's part of the Morgan Stanley platform. And we get nothing in order to make these decisions as an investment committee member. And they come in and say, would you like to buy this XYZ large firm product offering? And then you're supposed to vote. And I'm supposed to put on the record my vote that I'm okay with this with zero research. It's not what I expected would be the offering. So I don't actually know whether Morgan Stanley has more research or not, or if the advisor just doesn't use it, but it is not helping the investment committee at all to have these things presented to us with no research.
What does a fully vetted research package look like? Say, as an example, what you would have brought to your investment committee at Rice.
Ooh. So we have a shortened memo, which is probably 5 pages, and behind that is probably a 20-page document that was informed by, I don't know, 7 meetings and 15 research calls and a database that we went and did comparisons on. But that's not undoable. It's just not doable for a small team with 4 people on it to do all of that themselves. And so I think it's a very institutionalized process. Rice's looks like Yale's, looks like MIT's, looks like, Baylor University, right? This is a known thing of how to do this diligence. It's just that it probably should be done, and certainly as you start to go and have a more significant portion of your portfolio, anything north of 10%, it needs to be done.
How does someone get up to speed? Because I saw this 20 years ago in the hedge fund space, where you're starting a fund of funds because people couldn't quite spell the word hedge to their clients, and now private credit has this sort of strange phonetical spelling. People don't quite know what it is, but it's certainly getting adopted. Private equity to come. If you're in the seat of an advisor, and maybe your clients are asking, maybe you're just trying to get informed, what do you do to get up to speed?
Well, my first answer is always read. I read and read and read and read a lot and read reports and you read the public documents. Honestly, Ted's podcast is pretty amazing if you want to understand from one manager at a time, kind of how they're thinking about building their business, what their goals are, how they're organized, et cetera. And so I encourage you to check that out. I do believe that there's a role for a fund of funds when you're beginning in a sector. And in fact, Rice has used a fund of funds to help us with finding small hedge funds. We use one in Asia to find Asian firms to invest with, because we looked at the numbers, and you at the end of the day look at what are the fees I'm going to pay to this advisor to oversee or select on my behalf over this piece of the portfolio, and it's often less than what you would need to pay to hire a full-time FTE to work for you. And so you're then really diligencing this fund of fund as a potential partner to you and thinking, all right, do I believe in this person? Would I hire this person, this fund of fund principal, to be on my team? Where does it go wrong? I mean, lives are long for these private asset classes, and so who's to say that that principal will still be at that fund of fund 15 years later? I don't know, but at least hopefully you'll have gotten the majority of your capital back. That's the other preference that I would probably have when entering into private asset classes. I would have a bias towards faster return of capital. So things like private credit or a secondary fund, one of their features is that you're getting your money to work more quickly, but you're also starting to get it back more quickly. And I think that is a safer place than to go to, let's say, venture capital, where you're putting your money in over 7 years and you're getting it back over the subsequent 15.
It's pretty important. Our friend Carl Scheer, who runs the University of Cincinnati, has said, anyone who thinks nothing lasts forever has never invested in a bad private equity fund. I'd be a little careful about that. So if we take a broader picture of this, there's a lot of noise of, call it the democratization of alternatives, private wealth coming into private equity. How do you think about the implication of what we've seen, let's say it's in private credit coming, where there's vast amounts, hundreds of billions of dollars coming into a space potentially over, say, the next 10 or 20 years. What does that do to investment returns? What does it do to the experience that you're having if you're looking at smaller funds?
Well, there is a wave of capital coming in, especially in private credit, I think. One of the things that when we did the forward 10-year modeled returns in 2023 is that we are looking for substantively less outperformance from these asset classes than they've given us over the prior 20 years. So if we had 500 to 1,000 basis points of outperformance in privates, we're modeling more like 300 basis points of outperformance. So I think you have to ask yourself, is the 300 basis points worth it? Over long periods, it always is. But you have to ask yourself that. I really do believe that diligence is ever more important in this area, and this is part of why you have to think about hiring a manager the same way you think about hiring someone to be on your team. And you need to think about their firm and their firm's values and their firm's brand and the way that their firm has behaved in difficult situations in the past as a guideline for what you could expect in the future. And that is an important step of the diligence process.
It's always more fun to talk about the horror stories. So I'd love to hear, as you've gone through investing in the space for many years, what are some of the lessons you've learned from some of those, let's just call them horror stories? Go ahead and pick a particular one. You can name their name, phone number, email. We can
Well,
send them a text
it makes me so sad, right? Like I said, the small firms have the best returns, but they also have the worst returns. So I do think when you're with a small firm and something goes wrong, it is a much bumpier path to unwind than with a big firm. I mean, you saw with BREIT what Blackstone did. Honestly, it's not great to have more redemption requests than you can fund, but they went out and did a deal, raised a convertible, I believe, and or a note, and were able to satisfy redemptions over a relatively reasonable time period. When I'm in a smaller firm, these unwinds can be very ugly, and your access to information goes down. This sounds so depressing, because honestly, what you have to have is someone working on your behalf, whether that's, I think this is why fund-to-funds exist too, is that they have the relationship with those smaller managers and can push and argue on your behalf and help the unwind go well. Because it's a lot of work when something doesn't go well.
What does that look like? So, BREIT, tough example. In fact, it was University of California who came in with the convert. So you have this blend of the wealth space and the institutional space. When something isn't going right, pick a fund in your mind. I'm not a mentalist, otherwise I would say what the fund name is, but what was the actual experience like? What did you have to do when something was going wrong to get out? Oh, it's that fund?
Exactly, no. No, I mean, I do think you need to be paying, this is part of the other piece of the job is the monitoring piece, right? And so you need to know what's going on. This is why you have to have an FTE. Even if they aren't doing all the diligence, they're watching the trends and the manager and the asset class, because you need to start your redemptions earlier. I mean, honestly, we've been trying to get our assets back from China for about 4 years, 5 years. I think I got very nervous about the war on entrepreneurship in China, because our thesis was heavily on China, building Chinese national champions, building small businesses, and following the same pathway in general as America has, with a kind of innovation edge. And when entrepreneurs start disappearing, you have to get very worried. And you look at your investment firms, and despite their numbered track records, several of the firms we were invested with were single entrepreneur led firms. And without that person, there was no firm. And so I made the decision that we needed to redeem that capital. We have gotten back about 80% of the capital we invested in China since that time period. I have it up on my wall of the apocalypse. Where is Jack Ma? Because in my office, it's sort of like, if you can disappear Jack Ma, then you can disappear anybody. And so I think that's part of what makes institutions or gatekeepers like us valuable, is that we're watching the tea leaves and getting money back before it got locked down and you couldn't get any of it back. So I think that's a good example. When it's going badly, you're getting on the phone and offering the manager help. You're saying, how can we work this out? What are your problems? What kind of solutions could we have? You almost become an extension of their firm. And in fact, I've had a few of those calls over the last few weeks, which is like helping managers think through what can they do in the real estate market, for example, where they're going to have debt portfolios that are going to roll over at much higher interest rates than they had modeled. And so what is the right way to manage through that transition? The good managers want that help, and the bad managers do not answer the phone.
So let's do a couple little hot takes. As we walk through the different alternative asset classes, I'd love your, whatever you think is the most interesting contrarian view. Could be returns, could be something other people aren't thinking. And start with venture capital.
Oh, venture. Okay, go public markets execution of venture capital.
Meaning what?
So there are so many unicorns that no matter how big the IPO window opens up, they are never all getting public. But whenever the aperture is really small, the things that come out are pretty amazing, by the way. Go look at when Facebook's IPO was. And Salesforce missed the first quarter after they went public, for example. So I actually believe that a lot of the inventory that's been created in venture capital truly is as exceptional as they say that it is. However, it's going to be very difficult for venture capital itself to see all the returns that all the dollars they put in the ground come back. The things that come public are probably going to be extremely interesting. I think they're already out there. They fell off in 2021 with the pullback quite a lot, and many of the small caps have not recovered. So the most contrarian thing we did was invest in a kind of small mid-cap tech public fund.
How about private equity?
Man, PE is a hard one. I think it's co-investing with mid-sized firms that are going to have a hard time gathering capital. So that's what I think is probably the best returner, but that's a really hard strategy to execute. The one that I fight the most with my head of private equity about is Blackstone PE, big fund. Because I was like, it's good. It's fine. It's good. What's the problem? There isn't a problem. They're so large, they basically are able to do deals no one else is able to do, so they have less competition. There are zero endowments interested in that type of thing, so I'm like a pariah, and my head of private equity absolutely hates it that I like it.
All right, Allison, as we wrap, you retired after a long time, not too long ago. What's next for you?
So right now, I'm just doing lots of projects and sitting on a few boards. But I am interested in starting, I think, a money management business to solve some of these problems that I find families and individual wealthy investors having. One of the biggest problems I hear people say is they just actually have no idea whether they're doing well or whether they're on track with their savings. So if you all would talk to your clients more often about that, it would be awesome. Which is just fascinating to me. And it may be because people have spread their money around and you don't have all of their capital, and that's their big problem. They know how they're doing with you, but they don't know how they're doing with the rest of their portfolio. And so I do think that's a big problem. I think that the reality is, like I said earlier, endowments, foundations, and pensions are pretty much full up in the private asset and alternative space. And so all of the growth is going to come from people who do not have teams like Rice University. And so I am really worried about what is the market going to provide as a solution for all those clients, the people like my parents, so that they do not end up in funds that last infinity and have really ugly unwinds. And so that's one of the areas that I'm spending a lot of time thinking about, which is what could I do to help solve that problem?
Okay, last question. Favorite streaming show? I'll pull one right out of Animal Spirits.
Oh, favorite streaming show? Oh, it's so depressing. Only Murders in the Building. I mean, I love mysteries, right? That's my favorite.
All right, Allison, thanks so much.